Fintech companies promised a revolution. They offered easy-to-use apps and exciting features. People, tired of traditional banks, were intrigued. Fintech promised a new era of finance. It was innovative and user-friendly. Many people believed Fintech was the future of money management. However, the recent collapse of Synapse exposed a darker side. This event highlighted the risks hidden within the Fintech industry. Thousands of Americans found their savings frozen. The promise of Fintech suddenly seemed like a dangerous illusion. Synapse was a key player in the fintech world. Founded in 2015, it quickly rose to prominence by offering innovative solutions that bridged the gap between traditional banking systems and modern financial technology. Its headquarters buzzed with activity, a testament to its rapid growth and the trust it had garnered in the industry. Synapse acted as a crucial bridge between fintech apps and traditional banks. By providing the necessary infrastructure, it enabled seamless integration, allowing users to enjoy the benefits of both worlds. This integration was pivotal in the digital transformation of financial services. This innovative model was known as banking as a service, or BaaS. It allowed fintech companies to offer banking services without the need to become fully fledged banks themselves. This model revolutionized the industry, making financial services more accessible and efficient. Startups could now offer a range of banking services, from savings accounts to loans, without the heavy regulatory burden of becoming actual banks. This opened up a world of possibilities for entrepreneurs and developers, fostering a new wave of financial innovation. However, in May 2023, Synapse faced an unexpected and devastating turn of events. The company went bankrupt, sending shockwaves through the fintech community. The once bustling office spaces were now empty, and the future of many dependent startups was suddenly uncertain. The collapse of Synapse had a domino effect on the fintech companies it supported. These companies, which had relied heavily on Synapse's infrastructure, found themselves in a precarious position. The interconnected nature of the fintech ecosystem meant that the impact was widespread and immediate. One major casualty of Synapse's collapse was Yotta, a popular savings app known for its innovative approach to personal finance. Yotta had built its entire system on Synapse's platform, and the sudden bankruptcy left it scrambling to find alternatives. As a result, Yotta's system went offline, leaving its users in a state of frustration and confusion. Error messages and loading screens became a common sight as the app struggled to restore its services. This left approximately 85,000 users unable to access their money. The financial stress and uncertainty were palpable as people anxiously checked their smartphones, hoping for a resolution. A collective $265 million in deposits was frozen. The magnitude of the situation was staggering, highlighting the vulnerabilities in the fintech ecosystem and the far-reaching consequences of Synapse's sudden collapse. The Synapse collapse sparked serious concerns. Experts began to question the entire BaaS model. Was it truly sustainable? Did it put users at unnecessary risk? Michelle Alt, a former lawyer for a banking regulator, voiced her concerns. She acknowledged that the Synapse failure was unusual. However, she stressed the need for stricter oversight. Fintech bank partnerships required more scrutiny. The risks, she argued, were simply too high to ignore. Scott Sanborn, CEO of Lending Club, offered his perspective. Lending Club was once a fintech lender. However, it later transitioned into a fully regulated bank. Sanborn urged consumers to consider traditional banks. He emphasized the importance of direct relationships with banks. This was especially crucial for essential financial transactions. The BaaS model, he argued, was too complex. It obscured accountability, making it difficult to determine where your money truly resided. Section 5, the FDIC misconception. The Federal Deposit Insurance Corporation, or FDIC, is a term many are familiar with, but few truly understand. The Synapse debacle revealed a critical misunderstanding that shook the financial world. When Synapse, a prominent fintech company, collapsed, it left many users in a state of panic. Many users believed their fintech deposits were protected by FDIC insurance, assuming their money was safe no matter what. This belief was widespread, especially among those who had grown accustomed to the convenience of mobile banking. This was a dangerous misconception. The reality is that FDIC insurance has specific limitations and conditions that many were unaware of. While some fintech platforms displayed the FDIC logo prominently, it wasn't that simple. The presence of the logo led users to believe their funds were fully protected, but the truth was more complex. FDIC insurance only covers deposits in failed banks, not fintech companies themselves. This means that if a fintech company goes under, the deposits held within it are not automatically insured by the FDIC. Many users, enticed by the FDIC logo, felt misled. They had placed their trust in these platforms, believing their money was as secure as it would be in a traditional bank. They had assumed their money was as safe as it would be in a traditional bank, where FDIC insurance is a given. This assumption led to a false sense of security. This highlighted the need for greater transparency from fintech companies. Fintech firms must clearly communicate the extent of FDIC insurance coverage and ensure users understand the risks involved. Only through transparency can trust be rebuilt in the fintech sector. Section 6. Awaiting financial rescue. Weeks turned into months. Many Yotta users remained in limbo. Their money was still frozen. The bankruptcy trustee, a former FDIC chairman, admitted the situation was complex. Synapse's poor record-keeping made recovery difficult. The pooling of user funds in unconventional ways further complicated matters. The lack of clarity and slow progress frustrated users. They felt powerless and abandoned. This highlighted the real-world consequences of inadequate regulation. Section 7. Uncharted regulatory waters. The Synapse case presented a unique challenge. It didn't fit neatly into existing regulatory frameworks. The bankruptcy judge acknowledged the court's limited authority. The disputed funds weren't technically part of Synapse's estate. This novel situation exposed a gap in the legal system. Current regulations were ill-equipped to handle the complexities of fintech failures. It was clear that updated laws and frameworks were urgently needed. Section 8. The future of fintech. As we look ahead, the landscape of financial technology is poised for remarkable transformation. The integration of advanced technologies like artificial intelligence, blockchain, and quantum computing promises to revolutionize the way we handle money, invest, and secure our financial data. The Synapse collapse was a wake-up call. It highlighted the vulnerabilities within the fintech ecosystem, reminding us that even the most advanced systems are not immune to failure. This event underscored the need for robust security measures and the importance of building resilient infrastructures. The fintech industry, while promising, was not without its flaws. Rapid innovation often led to oversight, and the rush to market sometimes compromised the integrity of financial products. Professionals within the industry began to realize that sustainable growth required a more thoughtful approach. The allure of innovation couldn't overshadow the importance of regulation and consumer protection. Regulatory bodies worldwide started to take a more active role in overseeing fintech developments, ensuring that new technologies adhered to stringent standards designed to protect consumers and maintain market stability. As fintech continued to evolve, so too must regulations. Conferences and forums became platforms for dialogue between innovators and regulators, fostering a collaborative environment where ideas could be exchanged and best practices could be established. The future of finance depended on striking a balance. It was clear that innovation and regulation were not mutually exclusive, but rather complementary forces that, when aligned, could drive the industry forward. This balance was crucial for fostering trust and ensuring the long-term viability of fintech solutions. Innovation was crucial, but not at the expense of stability and trust. Fintech companies began to prioritize security and transparency, understanding that consumer confidence was paramount. Collaborative efforts focused on creating stable financial systems that could withstand the test of time and technological advancements. The lessons learned from Synapse's failure should serve as a guide for a more secure and transparent financial future. By embracing these lessons, the fintech industry can build a foundation that supports innovation while safeguarding the interests of consumers and the broader financial ecosystem. The future of fintech is bright, but it requires a commitment to learning from past mistakes and continuously striving for improvement.
So hit that subscribe button, ring the bell for notifications, and let's turn the page on a new adventure together. Get ready to experience books like never before, only on VBook 360. Like, comment, and share to support the channel and keep the video magic alive. Thank you for stopping by. And remember, every video has a story, and every story deserves to be shared. See you in the next video.